I have Ben Clifford, Managing Director with Argonaut, Sean Russo, who is Principal and Managing Director with Noah's Rule, Alberto Migliucci, who is Founder CEO at Petra Commodities Asia, and James Morrison, closest to me, who is Portfolio Manager at Regal Funds Management. We're going to try and cover a lot of territory, but I'd like to start with the boring one on allocation, and maybe Ben, you can start us off in terms of where you see a responsible allocation of gold into a portfolio at the moment.
Yeah, sure. It's a hard one to be definitive on. It does come down to the individual investor or the institution, but anywhere between 3 and 10% of the overall portfolio. And if you stand back and look at where estimates are and as far as actual weighting or allocation here and now, it's again really hard to get clarity on. But the World Gold Council put out a paper in mid-2022 looking at global financial assets. 265 trillion was the estimate, and 1% of that was allocated across institutions and private investors to gold, and that's gold bars, coins, ETFs, and those numbers exclude central banks, bullion and bonds. And for an asset that trades circa 130, 140 billion a day US, and that's up there with US treasuries and euro yen and what have you, it's a very, very large liquid market. You know, their conclusion was that, and it's not uniform, but that is actually an underrepresentation of where institutions should be, and on balance we agree with that.
Is there a consensus among the rest of the panel on that? Alberto, you're nodding along, sounds right to you.
Yep. I mean, the main thing is the liquidity too. You know, if you had held 20% in your portfolio and you had to sell it tomorrow, I don't think you'd have a problem. So that's quite a positive, but I totally agree. Yep. I'd actually go a bit higher than some of the percentages that Ben mentioned, but that's up to individual preferences. Yeah.
And what about why we're holding gold? Maybe I'll stick with you for the moment, Ben, before Sean and James come into it. But like, why are we holding gold? Why should investors be holding gold in their portfolio, whatever the percentage may be?
Yeah, sure. And a lot of this sort of comes back to that primary view that it's a great hedge in terms of market volatility. And, you know, it does play a role, but there are alternatives in that space. So, you know, Invesco put out a really good paper back end of 2022 looking at the alternatives over a 20-year back test, and you've got cash, treasuries, CDS, credit default swaps, VIX, short, medium-term options, strategies, gold, silver. Silver was the worst, given it's got that industrial metal pool, and in times of volatility you see it trade quite poorly relative. And gold was the best over the long run. So it does provide that really strong shock absorber for the portfolio. Some of those other instruments are actually better in terms of their return profile, particularly VIX and CDS, but the trouble is you've got to time it. And if you don't time it, you pay the price in terms of implied vol being higher. And if you're too early or too late, you can miss that window and burn premium in terms of the option strategies. So gold over the long run really does provide a unique, what's called zero beta part of your portfolio. It is an imperfect hedge, but it can play its role. And if you look back at the March quarter 2020, when we had the COVID shock, S&P was down 20% for the quarter. I think peak to trough it was down something like 32%, and gold for the quarter was +4%. So you're not getting rich out of holding gold during those volatility windows, but in terms of your portfolio and that airbag or that shock absorber, it's pretty unique.
Sean?
Well, I mean, it doesn't send you proxy forms. That's one good thing about gold. Jesus, I mean, seriously, like, you know, you think about it. I mean, the paperwork you get from small companies, I mean, it's an absolute nightmare. And by comparison, you just got gold. And over that 20-year run, I mean, I've got a kid just about to turn 25, working in West Australia at the time. Aussie dollar gold was 360. Today, it's sitting here at nearly 3,200. You know, if the grandparents had sort of said, well, what am I going to buy the kid given when he turns 21 or 25, they're not going short VIX. You know, hopefully they didn't buy him silver, but that idea that gold it's enduring, right? And that's the thing. Now, it's interesting, because that 20 years is a good time frame because it's been going up for the last 20 years. I started in the market in 1984, and I looked at the gold chart. It was about $400 on its way to 250, and I said, "What dickhead paid $850 for this 4 years ago?" Cocky 20-year-old. You go like, "What were they smoking?" But Russia was invading Afghanistan, whatever was happening at the time, right? But then they used to say gold is nobody else's liability. And a guy who I thought was old, and he's probably 15 years younger than I am now, when he said it to me, he said, "Sean, gold is nobody else's liability." And I didn't really get that. But the last 5 or 10 years, and I think in the last couple of years, the whole world is starting to understand the value of, they're not buying it yet, but that idea that gold is nobody else's liability, right? So, I mean, that's one of the reasons I think you hold it in your portfolio. I mean, you've got that low volatility, you've got the Swiss bankers portfolio, the idea 5 or 10%, hope you never make money, because if you're making money on gold, you're probably not making money on anything else. Well, at the moment, that's not true, so the world's really strange, right? Because you're making lots of money on gold and you're making lots of money on everything else, so that's a bit weird. But, I think that's really the thing for gold, is it's been around for 5,000 years. It's very low hassle to own, and it's actually, done very well.
It's a great point too. Gold does participate in rising markets as well. So a lot of those other strategies are really only focused around high volatility and falling markets.
James, you spoke about capital flows, or capital inflows, and relative to China in particular, and the function of gold there. That was in the briefing call, obviously. Yeah. I'm not going to pretend I followed it all.
No.
There'll be people here who are smarter than I am who might be able to follow you if you want to do it again.
So I received a presentation from a China expert the other day, and he was expressing huge alarm about the precipitous fall in the Chinese property market and new starts in apartment buildings, and essentially the massive overbuild and the crunch time that's coming because of the unsold units and so forth. And he was talking about capital flight, and he was saying, people want to trying to get money out of China any chance they got. And he brought up this great example, which I looked it up. It happened, I think it was in January, where a car leaving China was spotted by the customs people as those tyres look a bit flat, and upon a further investigation, they found a whole bunch of gold bars had been put on around the axle of this vehicle and sort of weighed it down. And so that's mobile wealth if there ever was one. And so look, I went and did a bit more research after that, and the Shanghai gold premium to London is about $20 an ounce, a bit over that perhaps at the moment. I think this expert on China said to me, in his view, Hong Kong had turned into essentially changed a great deal from when I lived there years ago. Essentially, it's a Bitcoin crypto place, and it's a facility for getting money out of China. And he said it's just one-way traffic. And a lot of the recent flows into the unexplained rally in the gold price, he was putting down to Chinese demand from individuals trying to get their money out. And so I don't know if I think this continues the theme that it is still a great vehicle for protecting your wealth.
Okay, and that's a trend that we're expecting to continue, or that your contact is expected to continue?
I draw on this fellow's experience. He said he doesn't think that the downdraft in Chinese real estate is anywhere near over yet. It's going to get much worse, and that he thinks the exchange rate will go from here to about, I think it's just around 7.7 or 8 or something at the moment. He thinks it goes to 10 or 12 RMB to the dollar, and so in that light, you will see further people trying to protect their wealth. And so, I think we'll see a lot of support for gold from people trying to protect their wealth.
Yeah, on James's point about the Shanghai property market, there's actually property developers trying to entice people to buy the property at the moment, which is in the doldrums, and they offer gold bars. So when you buy a new property, you get a few gold bars as well. So that's exactly what. So it's sort of a sweetener. Having lived in Hong Kong and Singapore and Asia for 20 years, Asians love gold. And you go to a supermarket in Singapore and there's an ATM machine just for gold, right? So that's the mentality. So there is, I think in the last year, there's been so much more buying gold in terms of not just bullion, but also jewellery, of course. I mean, there's India and China, and there's Singapore, Indonesia, Vietnam's big. You know, in Vietnam, you can actually buy a house with gold, so you don't need the currency. So it's a very big different mindset how they see gold, and you can see that reflecting in the gold bullion. But I think the gold price at the moment is quite high because of the increased central bank buying. And this might be a question later, so I might preempt it. But the difference between a high gold price now and some of the equity guys are lagging is because the central banks are buying the gold, and the central banks aren't the same buyers of equity. That's a different market. So there's a bit of a disparity there. But what I see historically is that eventually it's like a slingshot. When gold price is so high, ultimately the equity guys should follow up. And especially if you're producing, if you're a gold producer with a current gold price now, you're actually making some pretty good cash flow. But yeah.
Yeah, so we'll do more on that in a bit, but it's a good. We'll get to it. I wanted to go back to silver. You touched on silver, Ben, briefly. If we're saying that there's a fair bit of upward momentum behind gold at the moment for various reasons, some of the core drivers we talked about, what does that mean for silver? And looking at the historic ratio of silver to gold, where it sits at the moment and what it tells you about where it might go. Maybe come back to Ben for a start.
Yeah, sure. So it's obviously a monetary metal, but with 50% of its annual demand usually around that industrial production piece. So, you know, quite often it's referred to as the baby brother to gold. But, you know, right now that gold-silver ratio, I'm not sure the exact number, 75 or 85. It's very elevated. But, you know, going back to the point that Alberto made, I think you've got to look at what have been the real core drivers of the gold price outperformance over the last 18 months. You know, it has disconnected from that sort of inverse real yield phenomenon. And the question as to why that is the case is largely, I think, down to central bank buying. And, you know, we had 1,000 tonne of net central bank buying in 2022 and marginally less in 2023. But, you know, that was more than double the number for 2021. And that happened to coincide with the Russian invasion of Ukraine and the US actually weaponizing the US dollar. 600 billion of foreign exchange reserves for Russia. Half of that was wiped away due to economic sanctions. And you know, that's a big wake-up call for non-G7 countries. So the BRICS, and we've seen a response since then of, as we mentioned, central bank buying, and China's led the charge there. And it's hard to see that going away. And I think the point's a valid one that, you know, central bank buyers are very different buyers. They don't buy for a turn. They don't buy for a trade. And so in that sort of construct, yes, silver, I think is probably undervalued, and the gold-silver ratio is, you know, probably 2 or 3 standard deviations away from the mean. But I find it hard to see an immediate catalyst other than high gold prices for high silver prices.
Yeah, I mean, I'd agree with that in the short term. Because if it is this, you know, central banks and probably ultra high net worths as well coming in now into this market, and they're not buying silver. The other thing is, if you're buying it for, central banks don't buy it, if you're buying it for flight of capital from China, if the guy had a problem getting his money out of China and the wheels looked a bit flat with gold, he's screwed with silver, right? So, I mean, that's why gold is so fantastic. It takes up so little space. But the silver, poor man's gold, they used to call it, and all the tin hat guys have all gone off to crypto. So silver's lost a huge amount of trading volume to crypto. I mean, they'll come back at the right time. But I mean, Charlie Morris, who Bytetree, who does the Atlas Pulse report, which is probably the best free bits of research you'll ever find on the gold market and silver. He's saying, you know, if you're bullish gold, and the central banks are just one of the reasons to explain what's going on. It's bigger than that. If you're bullish gold, you've got to be really bullish silver. You know, if you're here for the cycle, that's it. Because the last 3 times we've gone for a decent run, gold-silver ratio has been somewhere around 80, and it's ended up between 30 and 50. And so that's very real. And the other thing, a quick thing on silver, which is quite interesting. If you remember a couple of years ago when they were handing out all the stimmy checks in America, and the Reddit crowd got in and they were going to squeeze silver, like silver to the moon and diamond hands and all that shit on Twitter. Sorry, this is being recorded, isn't it? So you got all that stuff going on, and they were all piling into silver. And we wrote a note to our clients at the time going, all-time highs, rupee, silver. And in India, no one's giving you a STEMI check, right? In India, you're trying to figure out how to survive. They're going to be selling silver at this price. Everyone in India, and they're the biggest holders of silver in the world, individuals, no one is not long and in the money. And these American guys are coming along with their STEMI checks thinking they're going to squeeze these guys like that Dumb Money movie. You know, you've got a short fund on the other side. You've got the whole Indian population there. And sure enough, they just ran into a wall and it fell down. So if you want to look at silver, one of the things to do is to look at the rupee silver price. Kitco, you've got a little thing down the side. You can keep an eye on that because if that breaks, that's going to be different. But the other thing is with the ratio, the Indians are very discerning. If it gets to like 90 or anywhere up there, they stop buying gold and they actually start buying silver. You know, I think people are going there all the time because they know in the long run they're going to get, you know, they're going to sell 50 ounces of that silver, get an ounce of gold and have 40 ounces of silver for free. I mean, that's their mentality. It will come back at some point. So the other thing to say, if you're going to trade silver, you've got to be pretty good because Bill Gates, who tells everyone how to run the world, and Warren Buffett, the world's best investor, they got their ass handed to them trying to trade silver back in the 90s. It's not an easy market, and the Hunt brothers before that. So it's not easy, but if gold's going to go, silver's going to go nuts at some point.
Yeah, and central banks have changed their behaviour somewhat. I mean, I saw Gordon Brown, who was Chancellor of the Exchequer in the UK when the UK decided to sell their gold in the late 90s, getting completely rinsed in the UK press just in the last couple of weeks. And you know, but I was, you know, I've seen a lot of central bank movements. So I was lucky enough to work in Zurich in the early 90s when the sale of the century was on, when all the stands would arrive at Zurich airport with their plane load of gold and sell it. And that's why gold just stayed there, because they were just dishoarding like crazy. As soon as they got given all that gold, first thing they do was go shopping. Go and sell the gold and reinvest it. So that behaviour is gone. I don't think we're going to see dishoarding from central banks. I think we're going to see buying from central banks on a continuing basis for the reasons that Ben was alluding to, that we've got a much more complicated, potentially, you know, no one's going to leave their gold at the Bank of England if they think it's going to get confiscated, I don't think.
If we're on the central bank, have we moved on? Can I just quickly throw some stats? I had to write these down just to get them right. So the Bank of Japan has bought $475 billion worth of equity ETFs trying to stop deflation in Japan. And the Swiss National Bank, trying to keep the Swiss franc under control, has sold $140 billion US worth of Swiss francs. And then with the US dollars that they got, bought equities. The Swiss National Bank owns 7% of Apple, 6% of Microsoft, 3% of Amazon, and 2.8% of Nvidia. Now, central banks used to buy gold. Those guys, you know, they went out and bought equities. Everyone said you're mad. Right now, they're looking pretty clever, right? But no other central bank's adopting that. I wouldn't be surprised when we unveil who are the central banks that are in buying market, we look over the next little while. The idea that the Swiss National Bank or that the Japanese, as they're changing their stances, aren't switching out of US equities, these equity positions they hold, back into the more traditional, sensible thing of gold, as all their other peers are, could be very real. And just in case you're wondering how much gold that is, if the 615 billion just those two central banks do, that's 279,545,455 ounces of gold, or big swingers like James like to talk in tonnes, that's 8,735 tonnes of gold. That's equivalent to 3 years of total mine supply.
Same as the US Reserve.
Yeah. So that's the kind of money these central banks have got in equities, probably looking to be shifting back. So even a 10% allocation of that would be like 870 tonnes. And the biggest ever central bank non-reserve purchase ever was in 85, was the Hirata coin for the Japanese, 220 tonnes. And that moved the market, you know, enormously. So yeah, it's pretty exciting.
So we will move on to gold as a trading opportunity, or looking at essentially gold as insurance trading. The difference between the approaches, like whether people should be looking at gold for capital gains or whether it's just an insurance play. I know Ben touched on the fact that gold actually rises in improving markets as well. And looking at physical investments versus ETFs, and then Alberto's piece on the disparity between equity prices at the moment and the run that gold's on. I don't know where we really want to start with that, but maybe Alberto, you can take us back to essentially insurance versus trading, and if you see gold right now as something that you'd be looking at as a trading opportunity.
I think one of the reasons gold's gone up to is the lack of confidence in fiat currency at the moment. That's a big thing. And that's why, surprisingly, people sometimes try to think that Bitcoin or cryptos and gold are competing against each other. And I guess Bitcoin has eaten away a bit of into gold sort of territory. But you look at both gold and Bitcoin in the last month, they're at record highs, right? So that's interesting because people would say they're actually opposites. And I could argue from a fundamental point of view they are opposites, but they're not in terms of they're both united against a lack of confidence in fiat currencies, in governments, in US dollar. And so that's an interesting concept. So with this turmoil in the world, the safest place to put your money in is gold when there's turmoil in the world, right? So that's sort of said. So I think that's the point. I don't think it matters whether it's ETFs, bullion, or equities. I mean, like I said, equities needs to catch up. Equities is a bit below for another reason is that not only proxy forms, and I hate filling those out too, but I'm sure there's an accountant here or a corporate secretary in the audience that will do it for a fee. But also the problem with most mining companies, including gold, is the ESG layer now. So there's added ESG compliance for all these companies. And that's probably holding them back a bit in terms of the cost to produce the gold. But otherwise, yeah, I wouldn't discriminate too much whether it's an ETF or equities. I mean, the two speakers before this panel, both good gold companies, Larvotto and Aura. I mean, Larvotto's got 1.4 million ounces of gold at over 6 grams per tonne. I mean, the value of that is quite high, and it's only got a market cap, I think he said, of 15 million, which is crazy, because if you have to convert that into an ounce thing, it's 40, 50 times more, right? Well, that's probably an exaggeration. And so same with, that's Aura and Larvotto, they both got, so they're both probably totally undervalued as far as the gold price goes.
So I suppose it's a commentary on the risk involved in obviously developing these resources and delivering gold itself. Really, the piece that I think the audience is potentially most interested in is why are equities at the moment lagging the gold price, and does that represent essentially an opportunity because of the value that you're describing, Alberto, or are we talking about something systemic where there is a disconnect now for the first time for some reason?
Yeah, can I have a crack? Very, very simply, I think it goes like this. Most of the money in the world is in the hands of generalist fund managers, although 50% now of the money, apparently we just passed in the US in this last week or so, 50% is now passive. That's just a disaster waiting to happen. But you've got generalist investors, they don't like to invest in gold. They don't even really like to invest in mining, which is obvious by the very small percentages of the S&P that energy and mining and stuff make up where we are right now. So your average investor, generalist investor, only makes an allocation to gold if gold is outperforming general equities. Gold has been keeping pace with general equities in the United States for the last 5 years, but it hasn't outperformed. So the ETF volumes that everyone watches, where the generalist investors go to invest in gold, they've been coming off. So while central banks in Asia have been buying, generalist investors have been going off because it's too easy to make money in the other markets. Once they decide that they want to come across, then they look at gold equities outperforming gold. And the overwhelming position is, if you look at the indices, not individual companies presenting at this conference, not a lot of our clients, but the indices overall have been underperforming gold. So your generalist investor with the big money, if they make an allocation to gold, it's very difficult if they're going to say gold producing companies to give me the leverage, because companies for years have been telling me I'll give you leverage to gold, and they don't. And that's the problem. The exploration upside and the kind of things where people add enormous value with the drill bit, that's different, but they're not coming anywhere near that. But the generalist investors, it's just, they can't even find a reason to be long gold at the moment. And if they can't find a reason to be long gold, they're certainly not going to find a reason to be long gold equities that as an industry are underperforming the gold price.
Yeah, I can give you a slightly different viewpoint. Probably not everyone knows, but I'm managing a royalties fund. We've got a mining and energy mandate, and so we've just made an allocation to we just acquired part of $75 million US gold stream over a gold mine in Canada called the Greenstone Mine, which is run by Equinox. We did that in October, and we get our gold exposure by those stream payments, and so we now have about 25% of our exposure is to gold, and we're very comfortable with that, and so we're getting our gold exposure that way. You know, they have to deliver gold to us every month, and then we sell it if we choose to. And so, you know, and what we're doing for investors, it's a very difficult market to raise money in at the moment for everybody, and so we have to do the same thing. And what we've decided to do is to have very high distribution to investors, so we can give them make very generous, I guess, distributions of the royalty receipts we receive, and then raise money from them again on the basis that we are providing income and capital growth. And so I feel that ours is only a modest success. We've got, ours is quite a relatively small fund, but I feel that for the industry to raise money now, they need to show a way they're going to return money to their investors in some way. And I think that's the challenge right now.
Okay, and I may have very high chance I've misunderstood some of the points here, but I guess what I'm quite interested in personally is I think I understand the reasons why there's a disconnect at the moment. What I don't really understand is there evidence that this will reconnect at some point, that at some point some of the buying that at the moment hasn't reached to gold, is that going to reach gold at some point, and then will it naturally go on to equities, or is that not necessarily the case?
Yeah, look, well, yeah. If general equities were to roll over right now, if this is the high, and the Dow gold ratio right now, if you divide the Dow Jones by the gold price, it's about 19. Right now, when Pierre Lassonde came to Australia in the late 90s, early 2000s, said, get over yourselves, gold's going to go up, one of mine too. It was 40 to 1, and it ended up at 5 to 1 in 2011, right? So gold outperformed general equities by a factor of 8 from the early 90s to 2011. Since 2011, it's gone back from 5 to about 19. But in the early 2000s, when the gold bull market really started in 2005, it was 20 to 1. In the 70s, when gold was on its way from $30 to 80, when the Dow Jones ratio got to about 20 to 1, and then started to drop, the bull market really took off. So we're there at that level again where bull markets have started relative to equities. So gold is inexpensive relative to equities right now, right? You can sell a basket of the Dow Jones and get 18 ounces of gold. You can only get 5 in 2011. So gold is cheap relative to when it was at 1,800 in 2011, if you bring your money from equities across. If that ratio starts to drop, either because gold really takes off, but more likely general equities come off. So it's hard over there, and now they come here. I think that's generally what has to happen. If you look back in the history when gold equities do really well, it's when everybody else, it's a really hard way to make a living. So people aren't going to invest unless they really have to, if you know what I mean. But when the rest of general equities are tough, and that's the easy money's gone there, and you're not making money every night in the video or whatever, the money comes back, gold will run. Then yes, the allocations will go to the large cap companies first, because most of these generalist investors, our industry is so tiny at the moment that most of the companies have a market cap so small they won't even be able to invest, which is part of the game of everyone merging to get a bigger market cap to get in the ETF at the moment, even if the merger doesn't make sense, but you get a bigger market cap. So there's an investor out there that'll buy you. But we're all waiting. We've got to wait for something else to happen. I don't think the gold industry's got to do, it's doing a lot better than it used to. There's still some bad practices, but you basically need, if it to stop being easy just to be in general equities, I think is the reality.
Okay, and so essentially they go into the larger equities, and then eventually at the top of it they'll get down to the
and then those guys need the reserves, so they buy the next guy. And, like Alex said, someone's either going to come and buy them outright, or they're going to say, I've got the mill, you've got the feed, or whatever. But in general, the guys with the mills are going to be running out of feed.
Well, as long as the gold price stays high, and the equity prices are down here for gold stocks, especially the junior ones, at some point when these guys hopefully start to produce, they're going to be making some significant cash flow. Banks will like that because they'll see a good price deck to lend money against, so you can get debt and other equity raises at that high, well, not a high valuation, but you probably get debt, so you can acquire or expand capex, and it flows through the system. And ultimately, this company will go up because it's got healthy cash flows, it's got access to banking lines, and like Sean said, it's that top end of the market that gets the first dibs or the first love from all the investors. And eventually the gold dust, excuse the pun, trickles down to the juniors, right? And then it's...
But to James's point, in the meantime, if gold price is high and your equity price isn't, and you can make cash, then you should be rewarding the investors to stand aside. Because one of the things that most people do look at, if a company that can't pay a dividend, they worry about its general health. I mean, not the kind of punters that want to have a go, but generally people looking at that. And I think mining companies, I mean, that's an issue, right? People looking more and more for income. And if you're not getting in your share price, you're going to have to reflect it in paying, I think, a reasonable dividend. I don't know what, as a fund manager, how you see that.
Yeah, don't disagree. It's just a very sort of challenging market that could turn into a bull market. But right here, right now, flows are everything, and passive community, more than 50% of stock holding. You saw that in the GDX, the main ETF in the US, as at the end of February calendar year to date. I think the outflows were close to $2 billion US. In the interim, Bitcoin had seen close to 14 billion in inflows as at the end of last week. It's probably 16 now. So there's competing interest, but there's also sentiment, and there's also flows that drive share prices, which drive sentiment. So you've got that sort of circular reference at the moment that we don't think it lasts. We think there's going to be that trickle-down effect, but it just takes time, be it a macro catalyst, rate cuts, what have you, for everyone to sit back and realise that a high gold price is here to stay.
There were a couple of other points that we talked about throwing around, and I will come back before we close just to put you on the spot and get a gold price forecast from each of you if you're prepared to share that. But there are some big brains that are in the audience, and I wanted just to see if there are any questions for the panel that anyone wants to throw at these guys while we've got them. Maybe the brains aren't that big. There's some over there. Okay.
Hi, just a question. Does Russia have anything to do with the gold price at the moment?
Yes, they're a significant gold producer. I think they're buying most of their own production for the central bank at the moment, and I think that they were caught with, I think, gold reserves outside Russia, which I think have been kind of, I don't think they've been confiscated, but they've been, say, quarantined for a period at the moment. They're not accessible to them. So I'm not actually 100% on that one. I know they have got treasuries as well and things like that, but I think that they are buying most of their own domestic production for their own purposes now. And so they have been, and in the past, we did a huge amount of trading with the various Russian entities. It was a big part of my early trade. Every morning they'd ring up and beat us up. But anyway, so yes, can I answer your question?
Would there be like an international sort of force to keep the gold price low so that Russia doesn't get funds for any further war activity?
No, I'm just talking about their domestic. I think their policy is to buy most of their own domestic production. I don't have any idea.
I mean, they may well need it to then pay their bills to China or whatever for energy, right? Like people would be looking for that in terms of making international payments. We've seen that in the past, for grain or vice versa. They are. Rick Rule talked. It was interesting. His presentation. His big thing is that they're selling. They're on the sell side on palladium, platinum, nickel. They're cleaning out the cupboards just for cash. And last time they got into trouble, it was the same thing. So they're probably not a seller of everything. The gold will be the one thing they probably have to hang on to because they've got to pay their bills to people for all the arms they're getting from North Korea and Iran and everywhere else they're helping along. So,
just an observation. I think the site's gold.org. I'm not quite sure, but it publishes annual returns on gold, and if you look at gold in Australian dollars, it's something like 8.5% a year average over the last 15 years, which you think, goodness, why didn't I buy just gold instead of stocks? But if you go to an investment advisor or financial people and you say, what do you think of gold? And they say, well, we don't even consider it. If we said to buy gold, people would buy it and bury it in the backyard and they'd never sell it, so we don't make money. So it's this catch-22. And then you've got, seems to be a an effort to keep the gold price suppressed so that the US dollar doesn't collapse into nothing because of the debt levels they've got around, that are around the world. So everything seems to be interrelated to suppress gold, which is starting to creep up, but it's just has a negative effect on stocks or in general.
Yeah, I think, that's an excellent point. And the US dollar and the US debt position right now, particularly leading into an election, which we'll probably get to, but it's staggering. So 1971, Nixon went on television on a Sunday night and said, we're closing the gold window. US national debt was 13 trillion. Right now it's 33 trillion. At the current run rate, by 2036, the US national debt will be 100 trillion. The annual interest bill right now is $1 trillion. That's more than defence, that's more than Medicare. And when you stand back and look at Jerome Powell going on 60 Minutes, not 2 months ago, to say we've got the last mile to fight against inflation, sure, that was a clear message, but he also really did focus on the debt load in the US, and they've got a day of reckoning coming. And we talked about Japan earlier, having lived and traded in that market and going back there recently for a holiday. One, nothing much has changed. Two, they're probably 15, 20 years ahead of the US in terms of the playbook. Demographics similar in terms of where the US will get to, but more importantly, the debt load. And you've seen Japan, they've had to really suppress interest rates because they know that they can't actually handle higher rates given the debt load. And what has that done? It's seen dollar yen, so the yen weaken from circa 95, 100 to 150 over the last 6, 7, 8 years. And again, to the point earlier, that's about fiat currencies. So governments are in a really tough position this year, and we've got an election coming. Very hard to see either party slowing down on the spending front.
And sorry, not surprisingly, yen gold is at all-time record highs, which has provided perfect cover for Japanese people against that, to that old nobody else's liability, right? It's there's the one thing that no one can tamper with, if you particularly got it in your hands.
On that point, before we do get to the final gold price forecasting, it's not just the US election. There are a swathe of elections across the Western world mainly, but across the globe. What's that likely to do for gold, and what are the different levers that will need to be pulled, or results that we're expecting that could push gold one way or another, or is there only one way?
Oh, well, I mean, I suppose with the main election we're all looking forward to is the US election in November. It's in the calendar, Sean, come on. And I think that I've just come back from North America myself, and I can tell you that, there's a lot of people who think that Trump will win, right? And that's not a popular narrative in this country or in many places. And I can only think that will be. I think it just introduces that sort of hand grenade rolling around the floor. No one knows when it's going to go off, right? But it's going to be very destabilising, I think, and it will be potentially very bullish for gold price, I would imagine.
Any dissent?
I concur, and I think the wild card is that Trump has previously spoken about bringing back the gold standard. It's not our base case, and it's long probabilities, but I think right now the conjecture is that John Paulson, the billionaire hedge fund manager, who's a renowned gold bug, could be the US Treasury Secretary. He's made it very clear that he's not going to reappoint Jerome Powell. He's looking for a new Fed governor that's a little bit more favourable to lower interest rate environment. So it's wide open in terms of where the gold price can go if Trump gets in.
The other thing is, just doesn't matter which stripe, which colour politicians get in. It's inflate or die. If you've got big debt, the only way that you can get rid of inflation. So they talk out one side of their mouth about trying to get inflation under control. The last thing they want really is to get inflation under control. And if you look around the world and what's happening with wages, I mean, workers have been screwed for years. If you price wages in gold, workers have been going backwards at an alarming rate. So you're seeing big wage rises in Japan. You're going to see big wage rises everywhere. And I think the Chinese started beating up companies and going pro-labour versus pro-capital a couple of years ago. And I think that's going to happen all around the world. And I just think inflation, I'm of the view it's like the 1970s. And we've got this first hump and we're going to get down here, and then it goes again. So, and that's a good analogue for gold and what happened. Gold went up to 200 from the bonanza. He interrupted bonanza of all things. It went up from $35 to 200. Halved to 100. There's a wonderful collection. I think Richard in the audience showed it to me. He had it one of all these very bearish headlines when it got to 100. Like that was it. Gold's all over. It's been to 100. It halved, and then in the next 3 years it went to 850. You know, and it went pretty quickly. But that was in the background of just runaway inflation, and I think that's a potentially quite possible what's out there, particularly if Trump in. But all of them really, they're all the same.
I'll wait for my prediction.
Yeah, we are out of time, sadly, for me personally anyway. This has been fantastic. I will get you to go from the far side back to me in terms of your forecasting and maybe just a couple of little pithy points on why you are where you are.
Well, if Biden is re-elected, the gold price is up, but if Trump's elected, the gold price will have a significant move higher.
I think even more importantly, I think gold will outperform almost any other asset class that you want to think about. So not just that gold is up, but gold will materially outperform general equities. I think almost anything that you sell and use the money to buy gold, you'll be able to buy more of it back at some point in the future with that gold, with the possible exception of really well-run gold mining companies that will finally come back and give you that leverage. But plain old gold, you know, that kind of thing that we get a move from 18 on the Dow gold ratio to 5, or even to the 1 Pierre Lassonde has always talked about. That kind of thing I believe is possible. 1980, Dow gold ratio went to 1 to 1. 850 Dow, 850 gold. I have said for many years, I believe before I die, I'll see the Dow gold ratio get it to somewhere between 3 and 1. I'm still on that, and I think it's out there in the next decade.
I'll take a slightly contrarian view with this Trump-Biden thing. In the election in 2016 when Trump won, just before the election, I took the same view. I said, Trump's going to win, gold price is going to go crazy. It actually went down. And the share market just bolted. So that caught everyone off guard, including myself. So I actually think if Trump wins, gold will go down. If Biden wins, gold will go up. Because I think we're already in a destabilized world. And if somehow I got to feel if Biden wins, this war in the Ukraine and the stuff in Israel isn't going to stop. Now with Trump, we don't know what we're going to get. So it could probably be worse, or we could wind it back. So Trump's like either way, right? But I just think with Biden, it's going to be the same, if not. I don't want to say use the word worse, but nothing's going to change. So it's not going to give any positive view, apart from the fact that they've got rid of Trump. So I'm not sure if Biden wins, gold price will necessarily go down. So yeah, it's a bit of a tough one, but I agree with what Sean said about the whole inflation thing. I mean, inflation is, someone in yesterday's presentation said inflation was coming down to, I think it may have been you, John. There was not your view, but it was coming down to a couple of percent. I don't know where they get those numbers from, but if anyone's paid their latest insurance premium, school fees, milk, petrol, inflation isn't 2%. It's not even 7%. It's probably double digits. So I think that inflation is cutting into your monetary value, your cash. It's like in the old times, in the Roman times, when they used to have the gold coins and the silver coins. The way of them reducing the value of that coin was to stick a hole in it and have less gold in there, or shave. They shave the coins to make it less weightier. And that was the government's way of tricking the citizens in terms of, rather than get your 1 ounce of gold, let's just shave it a bit, still call it, and that's a currency debasement. So I think the modern day shaving coins or drilling a hole in it is actually inflation. And inflation at 7, 8, 10%. I think gold might actually be a good hedge.
James?
Yeah, so I guess I'm generally bullish on commodities. So I'm bullish for copper. I'm very bullish for the underlying oil price, and I think that should be 120 today, and it'll be I'll be surprised it's not closer to 120 plus later in the year, possibly 150 US dollars a barrel. And in that environment, that will flow through to inflation. That'll be very supportive for Sean's view on inflation, that inflation goes higher. And I think in that environment, whilst the correlation's not really clear, I think people will see gold as a very, very, very sensible diversification and investment. And so, yeah, I'm bullish, but very bullish on the commodity complex generally.
Sounds like gold's going up. A very diplomatic lack of actual numbers here, gents, but thanks anyway. Ben, Sean, Alberto and James, thanks very much for doing this. Would you please thank the panel?
Thank you.
Thank you, guys.